Hey, what's going on, guys? In this video, I want to explore the topic of picking the right strategy that is the right fit for you. And I'm not talking about the best strategy here because I think it's even more important to pick something that is suitable to you rather than trying to optimize the maximum return or the maximum yield, right? Because some of these strategies might take a lot more time or take a lot more capital to be more efficient. So it's all about finding the right strategy that is the perfect fit for you. And I'll talk about how understanding yourself could help you structure your strategy better when it comes to yield farming, LPing, earning yield through crypto, or through other investments. I'll also talk about a few different strategies. Some of them are beginners and some of them are more advanced that you could apply to your portfolio as well if you believe that some of these could apply to you, and I'll give you a few different examples of investor profiles so that you could understand the differences when it comes to structuring your portfolio and structuring your strategy. This is really important to understand because some of the strategies that you see on this channel or on other channels, or if you see it on X, it might work well for them, but it might not work well for you, right? So let's dive right in here. And like always, this is not meant to be financial advice. Please make sure you do your own research, run your own numbers before you make any investment decisions, especially when it comes to investing more capital. From my experience, there's about 5 different factors that deeply affect which strategy that you feel the most comfortable with and that you could keep up with over time. Investing is often a long game. You're not going to be making like the absolute maximum return in 1 year, right? It often takes a couple years for you to even see the results. So these 5 things are capital risk tolerance, time horizon, time commitment, and skill level. So let's break down each topic here. Starting with capital. Your portfolio strategy could be completely different if you are starting with less capital compared to people who already has a ton of capital, right? So let's say you are in this zone here from $0 to 100K in investments. This could include your crypto portfolio as well as your other investments like stocks, or if you are holding like alternative investments too, like collectibles, it could be in this category, right? If you're in this zone, what is going to move the needle the most is just active income and compounded growth. At this level, you're not really trying to like get the best passive income strategy. You're not really worrying about like hedging the risk too much because oftentimes to generate a return in the market, you have to take on some risk, right? Even buying into the stock market, the risk is quite low comparing to crypto, but it is a risk still that you have to take if you want to grow your portfolio, right? Same thing with buying Bitcoin. You are going to be taking risks in the market to try to grow your portfolio. At this level, it doesn't make sense to like overhedge your portfolio because you're looking for growth, right? And then it also does not really matter as much to be generating that much cash flow as long as you're stacking more assets and then you're actually increasing the portfolio value over time. So at this level, growth is the most important, and actually having a good active income would help you boost your growth, right? A lot of people that have made a ton of money from investing, a lot of it is actually from active income first when they're growing their portfolio from scratch, basically. That's how I got my start in crypto as well. I got started freelancing art for an NFT project back in 2021. I did launch an NFT project with friends a few months back as well. Even though the income is not nearly as much as it was back in 2021 and 2022, that is still a form of active income. And I just enjoy doing art. That's why I do it. Basically, growing your portfolio from scratch is going to be very difficult if you don't have some sort of active income that you could put into your portfolio, right? Because to an extent, you could kind of control your active income and then you could also control your expense, but it's very hard to control investment return because sometimes the prices are just going to be trending down, right? In 2025, if you buy a lot of altcoins basically trended down the whole year. It did recover a little bit, but then also a lot of the assets did give back a ton of its gains, right? So At this level, again, active income is the main focus. And let's just say you're at six figures and above. It's basically the same as this category above, right? But at this level, it's about avoiding big mistakes. And the reason why is because if you have, let's say, a 500K portfolio and you don't make that much money, if you make a major investment mistake, you lose like half of your portfolio. That's going to take you a very long time to recover, right? At this level, I found that you can't really use the same high risk strategies that you might have been using to grow your portfolio from 0 to 100K, right? And this is also the level where you're starting to see maybe investment returns kind of compounding. But at this level, I don't think it's a great idea to like fully rely on your portfolio to live on. Because if the market is bad or if your portfolio is not doing quite well, you're going to be trying to chase returns or chase yield, which could lead you to a lot of trouble and making a lot of costly mistakes, right? So at this level, we don't have to go too crazy with the risk. And that's what I'm noticing about my personal portfolio as well. I've been taking too much risk. I'm just keeping my exposure to a lot of these altcoin assets, but I'm also adding heavily to my TradFi portfolio as well as other assets like gold and buying major assets like Bitcoin and Ethereum, right? And then also at this level is just staying consistent. We have to constantly remind ourselves how we got there in the first place and how to actually keep going, right? You have to keep up your active income. You can't overspend at this level. And you kind of need to keep growing your portfolio over time and not try to chase too much returns. Keeping consistent would bring you from 100K to a million over time, right? And once you break that 100K barrier, it's much better mentally. And it just feels good that you're on the right track, right? And then if you are at 1 million and beyond, it is pretty much the same as before, except that maybe you could focus more on active management. A lot of times, if your portfolio is not that big, then it doesn't really make that much sense to be spending too much time to manage your portfolio, right? Let's just say you have like 10K in crypto. It doesn't make sense to be like hours every single week managing your portfolio, where you would have made much more money if you spend that extra time to like increase your active income through your job or through your business, right? And this is also why I'm building Drippy. I am trying to get more active income. I am building software and community and education around liquidity pools and around DeFi. It's to build more active income for me personally and also to give more value back to the marketplace, right? The only way I could make money through my business is to provide more and more value to users, to customers, and that's my plan here to kind of grow Drippy and to actually get more active income. And then once I have more active income, I have a lot of clients that are at 1 million or above. So like 7, 8 figure clients. If you're already at this level, you don't really have to do active management as well. You could just focus on asset protection, right? The most challenging part about crypto, especially if you made your wealth really fast, you see it all the time where people make a ton of money through trading, through investing into high risk asset. They end up losing it all because they don't understand this concept or they simply cannot dial back the risk, right? It's going to be very challenging to recover your portfolio if you already hit 7 figures and then you make a ton of losses through bad decisions. And then if you are actively managing your portfolio, you should be doing different strategies that would protect your portfolio rather than actually dialing up the risk or you're trying to actually go all in into a higher risk investment. Maybe that's the thing that got you there, but we got to realize that also if you are taking too much risk, there's just going to be a chance that you could blow up your portfolio, right? A lot of people are over leveraged or they are buying too much risky assets. If you're at that level, it doesn't make sense to be using the majority of your portfolio to do so. It still makes sense to take a little bit of your portfolio and invest into things that you think would give you a higher return and asymmetric return. But at the same time, if you don't lay the foundation and protect your portfolio, that could be a very bad thing. So that's the capital portion. And then let's talk about risk tolerance. Risk tolerance is one of the first things that you have to kind of know before you actually invest so that you're not doing strategies that you cannot actually withstand, right? And one question that I found really helpful is like how much drawdown can you stomach? Like, let's say a portfolio goes from 100K to 50K, that's a 50% drawdown, right? The higher it is, the harder it is to hold. The reason why is you're basically watching your portfolio melt in value. And especially if you worked hard for your money, if you accumulated these assets for like a couple years, it's going to have really bad negative impact on your emotional health. You're not going to be sleeping well, and it's going to stress you out if you don't have a very high risk tolerance. And a lot of people going into crypto not really understanding the risk and not really being prepared for the potential drawdown. Every single asset in crypto could decline by like 90% or more, right? So we got to be prepared for that drawdown. And this is really important. Starting off, like if you cannot take a deep drawdown, then you want to think about like, okay, should I actually add some stable coins to my portfolio? Should I be adding other asset classes to my portfolio, like stocks, gold, real estate? That's typically the best way to plan out your portfolio and not dial up the risk too much, right? And one thing about risk is also it would depend on your personal situation. If you have a lot of dependents or if you don't have a high income, then that could affect your risk tolerance, right? Because if you're not making that much money and you also need the money, then you can't afford to take too much risk. A lot of people mistakenly believe that you need to actually put a lot of money into high risk asset when your portfolio is small to grow it. But at the same time, the story that we hear about like successful investors, they typically spend a ton of time on investing, right? That's number one. And number two, those are the success stories, and there's some sort of survivorship bias that come with it as well, right? There's also people that lie about their investment returns as well. It's very common, unfortunately, especially in crypto, even though you can kind of track their wallets and see it on chain, right? But sometimes people just don't do the work or don't look into it. So then there's a lot of that as well. And then there's also a ton of failed investors that don't make that good of a return and you don't hear about them that much. So risk tolerance is really important. If you are a high risk taker, we could be looking at strategies like altcoins, right? You could be yield farming some altcoins. You could be looking at some yield bearing tokens. Some of them are higher risk, some of them are lower risk. So it all depends on what you're into. And then you could also potentially look at stuff like options, right? But if you are a lower risk investor, you don't want to take that much risk, then we're talking about stuff like wider range LPs, right? And you could go really wide too. The wider you go, typically the lower the risk, especially when you are using volatile pairs like ETH to USDC. I've seen it time and time again. People squeeze the range, go in too tight, they lose a ton of money because they don't know how to manage their positions. And then the APR they get to keep at the end of the day is not that much compared to a wide range LP, right? So wider range LPs, right? Stuff like lending, liquid staking, and then just sticking with major assets, right? Asset selection is also huge when it comes to risk tolerance. I've talked to a lot of students and clients at Drippy and found that like you have to basically find the assets that you are comfortable with, right? For me, I am comfortable investing into some altcoins, but at the same time, if I have too big of an exposure, I try to trim that back and then stack more major assets like Bitcoin and ETH so that I feel more comfortable, right? Because at the end of the day, if you take too much risk and blow up your portfolio, you kind of would be setting yourself back financially. And it's just that if you have a low risk tolerance and you're using a high risk portfolio or high risk strategy, the chances of you capitulating and selling out of your positions is going to be much higher as well, right? I've seen a ton of people that cannot take a 30 to 50% drawdown on their portfolio. They basically sell the bottom because it's just too painful to watch their portfolio decline, right? Versus people with higher risk tolerance, they would see their portfolio grind down from, let's say, 100K all the way to 50K, but then maybe riding it all the way back up to 200K, right? So this is really important when it comes to understanding your own risk tolerance. And the next factor is your time horizon. Usually, it's better to have a longer term time horizon because as an investor, you just need to bet on assets that are likely to go up in value in the next few years, right? If you have a longer time horizon. But let's say you have a 6 to 12 months time horizon. Maybe you're looking at slightly tighter ranged LPs, right? If you set a range that could actually stay in range for 6 to 12 months at a time, that is still a sustainable range versus a lot of people that are rebalancing every single week or every 2 weeks. A lot of those LPs are not going to be making that much money, if any at all, right? But if you do have a shorter time horizon, I like to have at least a 6 to 12 months time horizon because a lot of times prices do swing up and down within the span of 6 to 12 months. If it's too short, a lot of times you're not going to make the maximum return. That's kind of like my sweet spot of like the shorter term plays. We could be looking at slightly tighter range LPs, or you could be looking at getting a better entry for a lot of altcoin to ETH pairs. And when altcoins do swing up against ETH, you could be looking to take your profits into Ethereum, just as an example, right? So that is the time horizon portion. But usually, if you have a time horizon that is greater than 12 months, then we could be focusing more on accumulation strategies, right? This is stuff like, for example, just dollar cost averaging into Bitcoin, into ETH. That is a very simple accumulation strategy, but also stuff like wider range LPs, right? You could, for example, enter into a bullish ETH to USDC LP. I have a client position that goes from 2,500 to around 100K. It's earning me about like 10 to 12% APR currently. And that's a position that we could just DCA into, right? Because that is a bullish range that will still have pretty good capital gains if ETH moves up in price by like, 100%, 200% over the next 4 to 5 years. So if you are focused on longer term strategies, you could be looking at accumulation strategies, right? So that's the third factor, time horizon. And then let's take a look at time commitment as well. So it depends on how much time you want to spend managing your assets, managing your investment. If you love investing and you're kind of using it as a hobby, then of course you could be running a lot of different strategies that busy investors can't, right? For example, one strategy is just finding niche liquidity pools where the total value lock is maybe not as high, but the APR is much better than those higher total value lock pools. And then maybe some of the assets are a little bit riskier as well. So I have seen a lot of successful active yield farmers too. They LP a lot of different assets, like for example, tokenized gold, and also a lot of lower cap assets when it's kind of trading near the bottom of the range where prices are low. They're going in with tighter range liquidity. And then they're using different strategies like de-risking their fees and then also being in a ton of different pools so that the chance of loss is much less, right? But it is a lot of time commitment. You have to scan and filter through a bunch of those pools. And if you're a busy person and you have a job or a business to run, then we want to kind of stick with mostly passive strategies, right? Semi-passive, where it doesn't take much more than like a couple hours per month to manage our investments. For my personal portfolio, it takes less than like 1 to 2 hours per month if I need to manage these positions. And the more positions you have open, it's going to take more time and more mental energy as well. In my opinion, if you don't have that big of a portfolio in crypto, it's still much better to just focus on your job or your business rather than trying to squeeze the maximum return out of your crypto portfolio. And if you are really busy, right, you just can't afford to be spending too much time on active strategies because it's going to actually not work out too well. You're going to be too busy to focus on those things. It's going to detract your focus from your job. And a lot of those higher risk strategies that might require more time could also bring you a lot more stress as well, right? So it's really important to know your time commitment and your personal constraint on that. And then let's talk about skill level next. So that's the fifth one. And the final one, I think skill is quite important. If you are just starting out, you might just want to focus on wide range LPs on major assets, right? Because that's one of the most simple things to do. You're going to be in range for a longer time. And then you also are not risking your capital on some of those other assets. And you might not have enough skill or experience to actually be able to separate the good assets from the bad assets, right? So wide range LPs is really helpful and stuff like lending, staking, very straightforward stuff, right? If you are a beginner, it doesn't make sense to overcomplicate the strategy. And let's just say you're an intermediate level LP or a DeFi investor. We could be looking at more advanced strategies like Nessa setup or the bull lever, the bear lever. You guys could look at that on my channel. I've made videos on those. Basically, a Nessa setup is when you are using a wide range liquidity pool, but also another tighter one inside that wide range. What that basically does is it would account for two types of market condition, right? You're still getting that elevated fees from the tighter range liquidity, but if the market becomes really volatile, your tighter range could get knocked out of range, right? That's where the wider range comes in. And I like to typically have more allocation to the wider range one. And even with the tighter range, I like to try to stay in range for at least 6 months at a time. So that is a more advanced strategy because you need to know about stuff like rebalancing, the internal loss that you could suffer, the risk that is associated with it, and you need to know how to manage those positions really well. So if you're a beginner, maybe those types of strategy is not the best to start off with, right? So skill level is really important. And for advanced users, we might have a more diversified strategy because once you know how to LP at the very basic level, you could use a bunch of other strategies to kind of diversify your earnings, right? Because a lot of times for liquidity pools, we are long in the market. For example, you can add a hedge LP setup that you could actually still make pretty good money. You will still have some long exposure for those types of setup. But if the market draws down too aggressively, you could actually use those setup to reduce the drawdown of your portfolio, right? Or you could be doing like basis trading or other option strategy to have a more complete and a smoother equity curve when you are building out your portfolio. But at the very beginning level, you don't want to be overcomplicating things like trying to hedge your LPs, you're trying to use options, and then you're also learning how to swing trade and you're doing a bunch of airdrop farming. It's just going to overcomplicate things. But if you're more advanced already, it could be good to look at stuff like airdrop farming and how to use like perps dexes, for example, right? So those are the things that I would be personally focusing on if I am already at an advanced level. And also I have the time to manage these different strategies. This is especially important because a lot of times like the strategies that you see online is more suitable for advanced users and it could be very tempting as a beginner to try it. You can and should try it if you are trying to learn faster, but at the same time, you would do much better if you don't scaled up those strategies too much, right? Because the more advanced the strategy is, if you don't know the actual math and you don't actually know how to manage it well, you could lose a ton of money in the process, right? And I've tracked a bunch of portfolios. I've seen people that have yield farm much longer than I have been, and they just still are not using the strategy well or are basically losing a ton of money in the process when they're yield farming because they're simply just not executing at a very high level. So that's the five things: the capital, the risk tolerance, time horizon, time commitment, and skill level. Now, let's take a look at a couple examples here. Let's call our first person Jack, right? So maybe Jack is in his 20s, and then let's say it's full time crypto because he made his money from meme coin trading or just from farming different airdrops or from trading NFTs. We might be looking at higher risk tolerance, right? Because maybe Jack is living alone in like a studio apartment. Maybe he doesn't have a family to support yet. And he's still relatively young. So if he blows up his portfolio, there's still time to recover from whatever he lost, right? But maybe there's also a constraint if you are working with less capital. Let's say Jack here is working with less capital. What is the best strategy in this scenario, right? So if I was Jack, I would be focusing on something that is very different from like a portfolio that is much higher. I'm not going to be hedging my bets too much because I want more upside and I am a higher risk taker. I have more time to look into different projects and stuff like that. So I might be looking at altcoins, right? And then I might be yield farming some altcoin pairs, and then I might be farming some airdrops as well. I would probably be creating content as well, kind of what I'm doing. This is very similar to my personal profile, except I'm not farming airdrops or doing too much active investing. I'm building the software for Drippy and then building out the community and the education. So that takes a ton of time on my end. But this is what I would do if I have smaller capital. But also, I want to have a barbell portfolio. So even if I'm taking a lot of risk with crypto, it's still very helpful, in my opinion, for this type of investor to be buying other asset classes as well. Just in case crypto doesn't work out, you're not like left with nothing and then you have to start over from scratch, right? I've seen a ton of investors just put a ton of money into altcoins, into higher risk asset, and when we're buying, of course, we believe that the prices are going to go up. That's why we buy in the first place. But at the same time, we can't tell the future. The market is changing all the time. The investors are changing. The bullishness is changing all the time. So we can never like guarantee investment return. So it's always good to be investing into stuff like the S&P 500 index funds to actually balance out the risk a little bit. And this is currently what I'm doing. Basically, some altcoins, some major assets, some S&P 500, some dividend stocks, some REITs, a pretty barbell strategy. And you can see how this might differ from the next example that I will show you here. And so example two, let's call him Jim. And Jim is in his 30s, maybe in his 40s even, right? So we got kids and a wife, and then we have a full-time job and or business, right? So you might be working full time or you have a business already. You're probably not going to be doing the same things as Jack earlier, right? And maybe medium risk tolerance because you have some dependence. But let's say you have a pretty solid job and a business that is going decently well. You might be comfortable taking some risk, but also maybe not too much risk, right? So this is like a scenario for a lot of people here, and let's talk strategy for Jim, right? If you are in this boat, we want to focus on wider range LPs, right? We want to focus on major asset and we want to focus on diversified portfolio. And then you want to put your active income to build your portfolio, right? So this includes like buying the S&P 500 or buying like an international stock market fund, all world stock market fund. That is one of the things that you could invest in. And you could be investing into wider range LPs. You don't want to use tight range LPs or too much active liquidity provision. You don't want to be farming too many airdrops or looking into too many altcoins simply because you're just a busy guy, right? You have kids to worry about, you have a wife, and then you have your full-time job. But you might also want to be looking at some altcoins, but that should be like a minor part of your portfolio if you just enjoy investing and you just enjoy crypto, right? That's part of what you enjoy, but you don't want to put like the majority of your portfolio in there simply because you might not have that high of a risk tolerance. And also you're constrained by time. And maybe because you're in your 30s or early 40s, you might not even want to hedge your portfolio too much because you're still trying to grow your portfolio, right? You want to accumulate these assets like ETH and Bitcoin. It doesn't really make sense to be using too many hedging strategy or you're trying to protect your portfolio too much. But you could be protecting your portfolio by having some stablecoin allocation or having more crypto to stable pool like ETH to USDC, right? So that would kind of reduce the drawdown of your portfolio a little bit, but still give you a pretty moderate upside. So this type of strategy for Jim is probably going to work out much, much better than a lot of active liquidity, right? And I have a lot of students and clients that come to me and say that, you know, thank you for teaching me these things because I was using like tight range liquidity. I was chasing the range. I was rebalancing all the time. I lost a ton of money. It's so stressful. And, I'm having relationship troubles and stuff like that. But then after pivoting to this strategy, it's just life just becomes much less stressful, right? And you're not forcing return, you're letting the returns come, and then you're looking out long term. Okay, if ETH goes up by like 20% per year for the next 4 to 5 years, then this is roughly what I could expect to generate, right? This is the type of investing that is probably better for like the 80%, 90% of the people, let's say, right? So Jack was that high risk taker. Jim is like a medium risk taker. And then let's just put John as a more conservative guy and maybe a guy that is in the 40s, 50s, 60s. And I know some of you guys are in your 50s, so this could apply to you. John is in his 50s and then invested for quite a while. So John has been building his portfolio for quite a while, right? And then maybe he has around 5 to 7 figures in crypto, right? And maybe you got into crypto really early on, and then you want to learn some DeFi, or you're just getting into crypto, but then you have more capital to deploy because you have been investing for quite a while. And let's just say John has a lower risk tolerance, right? So, what's the best strategy for John? So, at this level, especially if you are nearing retirement age, typically the best way to do so is to have a more diversified portfolio. And then you also want to have a diversified strategy, right? Maybe you are relying on some dividend stocks, you're using some options, you're providing liquidity, you're letting out your assets, you're maybe investing into some yield bearing stablecoins. That could be a way to diversify your strategy and diversify your income stream, right? Because maybe at this level, you're relying on your investment income a little bit. Maybe you're not working as much as you used to, you're dialing it back. And at this level, risk management becomes really crucial because you no longer can afford to take too much risk because then you would be left with very little money if you do take the risk and then things don't work out for you, right? And you're in your 50s already. You don't really have 20, 30 years to recover your portfolio, unlike Jim and Jack, right? So it's really important at this level to be avoiding the crucial mistakes. You're managing risk properly, and it doesn't make sense to be using too many high risk strategies. If you want to use a high risk strategy, I would recommend only limiting that to about 0 to 5% of your investment portfolio. So if those strategies lose money, then you're not compromising your investment return and you're still growing your portfolio over time, right? Because you have those other strategy in place. And at this level, you probably want to stick mostly with major assets like Bitcoin and Ethereum, maybe some other majors like Solana, and only allocate a very small amount to altcoins if you have time to look into altcoins and you want to take on that risk. But at this level, you typically don't want to take on too much risk. It also would depend on your total capital that you have and your time constraint and your skill level, right? So it's actually really good if you have more time in your 50s to invest the time into learning investing, learning about DeFi, so that you could properly manage your portfolio. If you are actively managing your portfolio, but you don't have enough investment knowledge, it's really easy to lose a ton of money. And then it's going to be very difficult to actually make your money back, right? For me, I'm not 30 yet. So even if I lose everything in crypto, I still have a chance to make really good income and make really good returns in the market over the next 30 years, right? And even then, I am diversifying my asset. I am accumulating these other asset that is not related to crypto. So it's really dependent on your personal situation, right? But hopefully all of this concept helps you out. These 5 things, if you understand yourself, then you could better manage your investment and plan out a strategy that works really well for you, right? Because at the end of the day, some of the things might work really well for me, but then it might not work well for you simply because a lot of these things might not match up, right? Hopefully this video was helpful. Thank you once again for watching. And if you have any question, you want me to cover a particular topic, I'd be more than happy to do so. Just ask them down below. And when I get the chance, I'll reply. And then if I find that it's going to help a lot more people out, I'd be more than happy to make these videos. Have a great day. I'll catch you on the next one.